From the City of London for our viewers worldwide, Bloomberg Real Yield starts right now. And we begin with a big issue, investors preparing for the US election.
The markets are nervous.
The election 11 days out.
If there is a disputed outcome,
we could have something that drags on for days or weeks. The question is, what if we do get this blue sweep?
If it's a clear blue wave outcome,
we're certainly seeing that narrative change.
Directionally, the rates are going to go a little bit higher.
How big of that interest rate increase could we see?
The technical picture is not great.
We expect volatility to continue even post-election.
You have to get past the stimulus conversation.
The bond market is kind of discounting that possibility.
And the election conversation.
Think through some of the near-term noise.
Putting that behind us will actually reduce the uncertainty premium in the market.
Really lucky to have with us today Sonal Desai, Franklin Templeton CIO of Fixed Income. Sonal, fantastic to get you with us on the programme. There is this narrative out there that regardless what happens in 2 weeks' time, things will be OK. Someone will deliver a fiscal package. How misplaced is that hope, that comfort that things will be OK, Sonal?
So, I think you've got to break this up. First of all, the idea that within 2 weeks we will certainly know one way or the other, that's number one. We don't know for a fact. Over the last several months, the market has increasingly become comfortable with the idea that mail-in voting will happen. We will have a blue sweep. It will all be very clear very shortly after the election, and the election won't end up in courts. And I think that it's a little risky to discount that completely, because that's the first thing, which could certainly create a certain amount of nervousness, let's say, in markets. The second issue is that fiscal package. Right now, we've come full circle from markets being concerned about a blue sweep to actually welcoming a blue sweep, mainly because they're eyeing an eye-wateringly large fiscal package as we go into the next year. And in the near term, I think that if we were to have the blue sweep and that package were to come through, that is market supportive. But again, it does come with risks which the market isn't looking at right now.
We see some of that in implied volatility in the equity market, Sonal. Do you see any of that in the credit market, though? And what do you make of that slight divergence?
There is a slight divergence right now. I think credit probably is maybe a little bit more vulnerable right now because it hasn't started displaying that fragility, if you will, as soon as equity markets, as soon, it's only, we've just got 2 weeks and equity markets are finally beginning to show a little bit of that vulnerability. But I think going forward, if we would have a disputed election, we could easily see yields go back, blow out 100, 150 basis points. That's what our teams think. But on the other hand, if we look, I think there are bigger issues at play as well. For example, the market's first knee-jerk reaction to a massive fiscal package is going to be very positive. We can see today that markets are reacting negatively to signs that that package isn't on its way. But the idea of a $3.5–4 trillion package coming through with a blue sweep, that's one impact. The other impact is what's going to happen to regulation. And I think there hasn't been sufficient focus so far, and that's going to have impact on specific sectors in credit. And I don't think that is fully in the price right now.
Well, let's talk about that then. In credit, credit spreads have become really tight again after April, tight. And as you've pointed out, we've had this indiscriminate rally in some places of credit as well. What are the sectors, the area of credit right now, Sonal, that you're concerned about?
So I think it's more than a broad brush all credit. It's really more the blind buying of everything which is out there. And I think the opportunities, especially over the course of 2021, are definitely going to come in actively selecting specific names. Everything is not going to be equally hurt or blessed. In the event of a sweep, for example, if we have a status quo, we already know how to deal with status quo. But if you had a sweep, in that environment, there are certainly sectors. We can look at energy, we can look at areas in healthcare, finance, potentially technology, where the market is going to have to sift through a lot of uncertainty. And if you add these sectors up together, you're talking about a large part of the US economy. And therefore, I think if we look through the course of next year, we really are going to need to focus very much on that active selection. there's nothing else to really say on that. I think there are other risks, by the way, which come from a macro level, and that again, I'm not sure the market is fully positioned for. We started seeing a little bit in terms of Treasuries slowly beginning to react to the other side of that potential $4 trillion package at a time that the Fed is very easy, and at a time where the economy is actually in the process of recovering, though now from here onwards, clearly the recovery will be slower than it's been so far. You know, we had the sharpest, strongest collapse, and we are likely to have had over the course of Q3 one of the sharpest, strongest recoveries. It'll still leave us at the end of this year probably down around 4% on GDP. But we continue to see a recovery, and you have to look, if we see the scale of fiscal support that we saw coming into COVID with continued easy monetary policy in an economy that is substantially better positioned than we were when COVID first hit us, that's going to have an impact.
Reading between the lines here, it sounds like you're expecting yields at the long end to rise, and maybe by more than people expect.
I would say that's reasonable. It's a question of when. Everyone's putting all their faith on the fact that the Fed will not raise rates. I would say the Fed has given itself enormous flexibility to act as it sees fit. Having said that, I don't see rates going up next year, Fed rates certainly not, over the course of the next year. But then if you do see a recovery supported by all this extraordinary fiscal and monetary policy, there is definitely the potential for inflation to surprise a little bit on the upside. And I know it's, in some ways, I sound like a dinosaur when I talk about inflation because it's really passé to discuss inflation. But having said that, you don't need a lot of inflation right now to have long end yields rise a little bit, because there seems to be enormous amounts of consensus that you're not going to see inflation rise above 2% into the indefinite future. 2% isn't so far away. We're at around 1.7% right now. So it is not outside the realms of possibility that inflation surprises a little bit on the upside. And the Fed perhaps moves faster than currently is anticipated, which is, I don't know, 2024, 25. I think that's very far out.
So,
and that's the medium
just hold
term
a minute.
risk.
You sound a little bit out of consensus here, that you don't fully buy into the Fed's new reaction function, the idea that they'll sit this out for the next several years. Is that a fair characterization of your view of things right now?
I would say that the Fed currently plans on sitting it out. And I believe the Fed, much like Keynes, if the facts change, I believe the Fed will change. We all in the market are looking at the Fed's dot plots and taking a great deal of comfort from the fact that there are no rate rises over the next 3 years. However, there are scenarios. The Fed has given itself an enormous amount of flexibility within its new framework. We don't know the look back period is. There are lots of degrees of flexibility for the Fed to certainly hold out, but then allow the market to start pricing in some moves slightly faster than the market is currently anticipating based on the dot plots. Of course, this depends on economic outcomes. There's another scenario of the world. If we stay locked down with social distancing for the whole of next year, we're looking at a completely different scenario. The Fed's on hold. I could see high yields start beginning to we could see credit spreads blow out, maybe not going all the way up to the thousands because, clearly the Fed would step in. But yes, we could go up to something like 700, 750. If, for example, through 2021, we continued to see, or rather, we saw a reimposition of very strong social distancing and lockdowns instead of a diminution of these factors. So there are lots of uncertainties is what I would say. And the market is not positioned for uncertainties.
So let me fit one final question in. This is a huge range of outcomes that you've just walked us through, both in credit and in treasuries as well. What is your conviction trade right now?
So our conviction trade is to essentially try, as is everybody, try to keep a liquid pool of assets which we can deploy, because since people are blindly buying an asset class, we also think they will blindly jump out if it appears that they got it wrong. And as such, we're standing ready to go in, and we do think that we will be presented with buying opportunities, because our baseline is not to have continued social distancing. Our baseline is continued recovery. And so we are positioning for that. We aren't positioning for the Great Depression and this being a 10-year period over which economies never return to normal. So that would be my conviction trade. Try to stay somewhat liquid, be ready to deploy, and be extremely careful. Don't buy entire asset classes.
Sonal, lucky to catch up with you today. Come back, please.
Thank
Don't
you
be a
so
stranger. Sonal Desai there of Franklin Templeton. Time now for the final spread. Let me run you through the week ahead. Coming up next week, new U.S. home sales and durable goods orders coming on Monday and Tuesday. Dallas Fed President Robert Kaplan speaking on Wednesday. Then it's a busy Thursday with rate decisions from the BOJ. And I think a big news conference for the ECB, plus another round of initial jobless claims in U.S. third quarter GDP. From London and New York, that does it for us. We'll see you next Friday at 1 p.m. New York time. That is 5 p.m. in London. For our audience worldwide, this was Bloomberg Real Yield. This is Bloomberg TV.